All right.
Morning, all of you. Let's start. I'll just briefly introduce myself. I graduated from Xavier's in 2012 and completed CA in 2013. Along with that, I completed CFA, FRM, CAIA, CS, and CCRA recently. And I've been a visiting faculty at Xavier's, JDBI, iLead, iTrade, BIBS, and a few more colleges, NSC, BSc, both the stock exchanges. I do a lot of corporate training in Excel at companies like Tata, Volvo, Genpact, Century Ply, Saregama was there recently, and quite a few more. Quaker Chemicals is there. So these are the companies I go for corporate trainings, majorly in Excel and finance area. And along with that, I do a lot of consulting work with MIS and forecasting and B plans and valuations, etc. Anyways, and the most importantly, we do our classes for CFA, FRM, and CA final finance paper. So I basically major only in the finance area. Even in the MS Excel part is more of application of finance and working with the finance area, right? So anyways, let's start off with the FRM part. FRM, basically, what is the degree all about? Why should you be looking at it? FRM designation is financial risk management. It is a finance degree which specializes in the risk management area. It is a finance degree that specializes in the risk management area. Now, say for example, um, we've seen the oil prices from $140 per barrel going down to touching almost a 20, and then again be rising to these levels. Now, oil can be a very important component when you're looking at, let's say, the textile industry, because that's a very important raw material for them. So don't you think that the bottom line or the top line, that is your revenues and the profits, are going to be very impacted, very much impacted, if the oil prices are changing to that extent? Look at the oil companies in general. The oil companies will be facing a lot of issues. Now the whole country is going to be facing issues with respect to its import bill, because we import oil. We are generally importers when we are talking about oil, right? So if the oil prices are fluctuating, don't you think it's going to be impacting us? The second thing, when you're importing anything, let's take another example. Say for example, we export certain products, we import certain products. In general, we import a lot of technology and a lot of resources, and we generally are the exporters of services to a large extent, right? So now when the dollar rates are fluctuating, say for example, the dollar rate changes from 66 to 69 rupees per dollar. Suppose, let's say I'm talking about a company like an Infosys or a TCS. Infosys, TCS, these IT companies are major service providers to the US and other countries abroad, right? If I provide a service worth $1 lakh, Infosys was earlier receiving 66 lakh rupees. I will fetch a bill to these people for $1 lakh. I will get that $1 lakh. I'll convert it into rupees because my company, the Infosys or TCS, is in India, right? So that will give me how much money? 66 lakh rupees. The same when the currency has turned to 69, I will receive this for the same $1 lakh worth of services provided. I'll be receiving $69, 69 lakh dollars. Don't you see there is a change of 3 by 66? That is a percentage change in your revenue. Just think about the impact in margins just because of this currency exchange rate, just because of what happened right now, demonetization. The kind of impact it has had on the exchange rates. Now think of it from another perspective. Think of it from a company which is more mainly import driven. Over here we are benefiting because it's a 66 to 69. Exporter is gaining over here. But think of it from an importer's perspective. An importer who imports, say for example, a small shopkeeper in Bada Bazaar area. He imports products from China and he's selling products in India. Now, whenever you're purchasing products from China, generally the bill is going to be denominated in terms of dollar. Now, he purchased a $1 lakh worth of goods to sell in India. His earlier cost was 66 lakh rupees. Today, his cost becomes 69 lakh rupees. Don't you think he's very much affected by the change in exchange rate? There is a risk that the exchange rate might change in a direction which is going to be harmful for him, right? So we need to evaluate. So there is a risk of the exchange rate changing when you're looking at an importer or an exporter. There could be a risk that the interest rate might rise or interest rate might fall. Say for example, I want to take a 10-year loan. I'll be starting a business. I'll be getting a loan in 6 months, 8 months time. After 8 months, if the interest has risen, don't you think there is a risk to that? Oil prices, be it input prices, be it output prices, be it foreign exchange risk, be it currency, be it anything, be it interest rate. So there's a lot of risk whenever you're doing any work, right? So risk management So FRM is going to be a finance degree which is going to look into the risk management area. One more very important application of FRM would be with respect to the Basel norms in the banking sector. Now what happens is, say for example, we've got the CA Institute. The CA Institute is regulating how the annual reports of companies should be turning out, how to prepare the balance sheet and the PL account, the rules and regulations with respect to that, and all those things we cover with respect to the CA examination, with respect to the CAs, right? Now, who is going to regulate, who is going to make rules and regulations for how the banks should be running? In 2007-8 time, in the crisis, the recession that started off, we have seen Lehman Brothers, a huge American bank, defaulting. Global financial crisis started off in 2008. So do you think, like, if I go to an HDFC or an ICICI bank today, can they tell me we people are bankrupt, I don't have money, get lost, you'll not get your money? Do you think ever that kind of a situation can come in? And if that situation comes in, it's going to be such a panic. You see the demonetization with people just because you have to stand in queues. If you have that kind of panic, just think if a bank defaults. You know the Sarda scam, we belong to the land where Sarda scam originated. So we know the Sarda scam has happened. You just think about it, the kind of impact that has. And we have seen an American bank, one of the strongest nations, a bank over there has defaulted, has become bankrupt. It's huge. You'll be studying about this. You'll be studying in part 2 about this. So when you're looking at these things, try and understand that risk management in banks has become very important. When you're looking at global transactions, nowadays nobody works only in the smaller locations. I saw the student of mine, he ordered some wire, this small bit of wire, there was some adapter, some changer. Basically Type-C cable and that normal USB, he had something. 40 rupees stuff, he ordered from China, Alibaba.com, that delivered him in India. So basically just try to understand the extent of globalization that is happening. Today companies want to work cross borders. Tata goes and buys a Jaguar over there. Not a Jaguar, a company Jaguar, the Land Rover. Right? So the transactions are so huge, they are so multinational, all the banks are working in all the countries all across. So because of these things, and the banks have become such a huge entity, and they are transacting at such large scale with everybody. And now the banking sector is not restricted to just accepting money and giving out loans. They're doing investment banking services, commercial banking services, retail banking. There's so much more that they're doing. Right? So with respect to that, we need rules and regulations on the banking sector for the banking sector. So that is Basel norms. There was Basel 1 that was upgraded to Basel 2, and because owing to the crisis, we now have the Basel 3. RBI, now Basel 3 is a regulation, it's a regulation to regulate the banks all across the globe. Right. Now, what we are doing is, Basel 3, now the RBI, see, a global entity cannot regulate what happens in India. RBI has mandated that all the banks should be complying with the Basel norms by March 2019. So by 2019, the Basel norms need to be implemented. A good chunk of operational risk, one of the subjects of FRM Part 2, is going to be dealing with your Basel norm section. A good chunk of operational risk part of your level 2 curriculum will have the Basel norm. So when I'm looking at an FRM, it's going to be with respect to the risk management area. It's a degree in finance, but it is focusing on the risk management domain. Right? That is briefly about what we're looking at FRM. I guess we all are okay? Okay. So let's look at the pattern and syllabus. Let's understand the content in detail and how the exam pattern and everything works, and then I'll give you all the information about it. Right? So you have 2 levels. Each of the levels take place in the month of May and November. It's always on the 3rd Saturday of the month. So you have 2 levels for FRM, FRM Part 1 and FRM Part 2. FRM Part 1 will have 4 subjects. I'll not write the exact names of the subject. The first one is going to be with respect to financial markets. There's going to be a little bit of theory over here. The first, foundations of risk management. So I'll give it to you. So the first one, the second one, this is your Part 1 syllabus. The second subject is your quants. The third subject is financial markets and products. And the fourth subject is valuation related, valuation methodologies, etc. Valuation related. Now we'll have the paper pattern is the first level is going to be a 100 MCQ paper. Alright, so basically we have a very well defined curriculum. So you have 4 subjects in the first level and 4 subjects in the second level. This fifth one is a part, these two are together. When we are looking at the first level, the 4 papers, you have a 100 MCQ paper. Your exam time will be 8 AM to 12 PM, and this is going to be an 80 MCQ paper, and the exam time is going to be 2 PM to 6 PM. You can give one exam in May and the next one in November. You are also allowed to give both the part 1 and part 2 together. But for that, if you clear part 1, then they will evaluate your part 2 paper. Say for example, if someone flunks part 1, your part 2 you will not even be told whether you've cleared or whether you've not cleared. So you'll not be told about it, right? If your part, no problem. If your part 2 exam, if your part 1 has been cleared, then you will be given the result of part 2 whether you've cleared or not. So you are allowed to give both the parts together, right? In the part 1 curriculum, you'll have 100 MCQs in a 4-hour paper. Part 2 curriculum will be 80 MCQs in a 4-hour paper. Generally, you will have 4 options per paper, per question, and there is no negative marking. There is no negative marking. There are generally 4 options per question. Nowadays, we see at times they will have questions in the format. A lot of practice books also we will see those questions, wherein you are given a data. You've been given like 2-3 paragraphs of data, and you'll have 2 questions or 3 questions based on that data. Generally, in the CFA examinations, we call that an item set question, wherein you have a decent 2, 3, 4 paragraphs of data worth of content, and on that, based on that data, we have 2 or 3 MCQs with respect to that whole data. But anyways, it should not bother us as so much about it. But this is what your paper pattern is all about. Now, when you look at the difficulty level of the exam, it's going to be a little, for those who understand CFA examinations, who've done or seen it, it'll be a little a notch higher than that. But that should not be a problem for you. That should not be a problem for you. So the difficulty level is decent. I'll discuss what kind of mix of paper and all we have. But this is your exam pattern, right? Now, when you're looking at the part 1, I'll explain the part 1 subject very quickly. This has got a little bit of theory in it, wherein an introduction to the risk management and all is done. A very interesting portions are there with respect to what kind of a code of conduct should a risk manager follow. What is the role of a chief risk officer, a CRO is there. So a little bit of theory is there. Why did the US disaster happen? So how did the 2007 financial crisis started? We have a chapter on that. We have a chapter on financial disasters. What kind of financial disasters we've seen in the past. Say for example, we've seen Barings Bank having a fallout. We've seen a long-term capital management company that was a hedge fund that defaulted. So basically we are trying to see in the past. Now say for example, maybe few years down the line, the new FRM syllabus will have financial disasters, will have the Greece crisis, the Greece country bankrupt, going bankrupt. Right, so financial disasters basically in the past, what kind of financial institutions and all have failed, have flunked, those disasters. So we need to study that in order to understand, okay, this went wrong over there. We should not have done this. Had I done this, this would not have happened. I could have mitigated this. I could have prevented this by doing this. So you should be studying. You should have an idea about what all things have happened in the past in order to not replicate in the future, in order to learn from your mistakes. That financial disaster is going to be there over here. So it's basically related to the risk management. And another part is going to be with respect to the portfolio part. I'll do the syllabus in detail. The second subject is more related to the mathematics and the quantitative part. When you're looking at the mathematics and quantitative, a lot of people have got they're very scared of, entering or even thinking about mathematics. Do not think of it that way. In the mathematics section, you do not have trigonometry or calculus or something. The mathematics portion is going to be focusing on the statistics part and on a little bit of probability and annuity part for those who've done this much in class 11 and 12. Even if you have not done that bit in class 11 and 12, it is not going to be a problem at all. It is not going to be a problem even if you did not have maths in 11 and 12. Of course, if you're an engineer, you will have a benefit, you will have an added advantage, you can cover this area in maybe 20 hours. If you're not an engineer and you're good at maths, maybe you'll take a 25 to 28 hours. But if you're not an engineer, you're not good at maths, you did not have maths in 11 and 12, you'll take probably a 35 hours. I'm not going to be misguiding you on that, but you'll need to put in that extra effort, but it's not. See, we'll be covering the mathematics area from the very basic. Like even the mean, median and mode, I'll start off from the very basic. So it does not depend on how much of class 11 and 12 you remember or how much of maths you understand. Like say for example logarithm. We don't need logarithm, but just this basic, like a to the power x is equal to y, therefore log y base a is equal to x. Just this much of logarithm is required. Because I try to prove at least 70 to 80% of the formulas, I will be deriving and showing it to you in the class. So that you can understand where the formula is coming from, how are you supposed to apply the questions, because questions cannot be that direct. Even if you have theory part, do not expect the questions, the MCQs, to be asking you what is the definition of this or which of the following is a point of this or not. I mean, you cannot have that straightforward, that basic questions. The questions are going to be very analytical, very application based, and you'll have to think and understand the content. You might find that, I'll read the theory and it's okay, I'll just go through it and learn it up. It is not going to help that way. You need to understand things, you need to apply that. Questions are going to be very application based. Questions are going to be very application based. So for those who do not have maths, do not have to think much, it's doable, it's absolutely doable. Put in that extra effort and start with a fresh mind. Right? So it's going to be focusing on the statistics, a little bit of probability and annuity section. I'll discuss it in detail again. When you're talking about financial markets and products, it's going to introduce you to all the kind of products and all. It's going to be these two papers. I generally teach you as in I do not go one subject, then this subject, then this subject. I'll tell you, I have an order of study and that is very relatable. As in there'll be one chapter over here, which I'll do with one chapter over here, because those two chapters are totally related. And you are supposed to be revising and studying at home also in the same order. The order of study and all will be provided to you. In what order you're supposed to be studying at home. That will be provided to you. These two subjects combined will be looking at more into the valuation part and all the financial products. Now I cannot explain you the derivatives part and all those things in that short, the way I'm explaining. There's something called derivatives for those who are already in the financial markets and working with respect to this. So you have products like forwards, futures, options, swaps. So we'll cover all those. All the fixed income security, the valuation and all. Let me give you a simple example. Say for example, a company has issued bonds in the market. Bonds, you must be knowing debentures, so we call them bonds over here. So when you're issuing a loan, suppose I'm taking a 10-year loan from the market. I took a loan from the market, a 10-year loan, when the interest rate in the market was, let's say 9.5% or something. Today, after a year, the interest rate has changed and it has fallen down to 8% or 7.5% or something. Don't you think I am at a disadvantage? I took a loan at 9% and now the rates have fallen. Had I taken a 1-year loan at 9% and after a year, had I taken another 9-year loan for the 7%, I would be saving on interest, right? So how do you value those? How do you manage those interest rates? How do you mitigate those risks? You're understanding the area? So those kind of things. So we need to understand how do you value those fixed income securities? How does a bond price will react to the interest rate changes in the market? It's not that complicated. I know these two subjects are relatively going to be new for those who do not understand finance, and that's the whole point of the subject, to introduce you to the financial products. This is not supposed to be known by you from before. These are financial products. I'll come to it again. Say for example, a credit rating agency. Suppose we're talking about a country risk. Let's say I'm talking about a CRISIL or an ICRA. You'll be looking at those, those companies that India's rating was BB and now India's rating has been revised downward to BBB rating or something, to a B rating or something. So countries are also given ratings. Now today a company, suppose, I want to invest in a company. I want to invest in either a Tata or a Reliance or an Aditya Birla Group. Now how do I invest? I don't understand. So I look at a report that is given by these credit rating agencies that this company is very safe, this company is not so safe. So how do they provide ratings? Based on the riskiness of the companies? I'll discuss this in detail. So this is going to be introducing you to all the financial products and all in detail. That is your level 1 curriculum. It is defined that you'll have 20 questions from here, 20 questions from here, 30 questions from here, and 30 questions from here. That is the whole breakup of 100 questions over here. So you have a 20-20 from here and 30-30 questions from these two subjects. The questions are going to be jumbled up. In CFA examinations, you have, one subject ka 18 questions, then you'll have another 14 questions from another subject. It's subject-wise, the questions are bifurcated in the first level only. But FRM in the first and second, both the levels, the questions are going to be jumbled up. You'll not have a subject-wise question paper. So you'll have 100 questions jumbled up, but the number of questions are going to be this. Right. I'll come back to this discussion in detail. The next one in your part 2, this is building your base. This is not going to be tested in part 2, but this is building your base. You need to have a financial base. So the first level is actually focusing on building a finance base for you, because the course is financial risk management. So we understand a lot related to risk, but this is going to be a very finance-centric paper. Finance-centric level. This is totally finance. There will be portions of risk and all, of course. This is totally understanding basic statistics and all when you want to enter into risk management. So this whole level is going to be focused on getting you into the finance area. Once you are into the finance area, in the second level, we are going to be looking at 5 kinds of risk, 4 kinds of risk, and another will be current issues. The question breakup would be, it is going to have 20 questions, 20 questions, 20 questions, 12 questions, and 8 questions. That is the breakup of these 80 MCQs in level 2. So basically it's equal weightage, 25%, 25%, 25%, and the whole thing is 25%, which is again broken up into 12 plus 8, right? Okay. Now when you're looking at market risk, say for example, if suppose the pound and rupee rate changes, Tata Motors is going to be including the whole of Jaguar in its own balance sheet. Tata Motors owns Jaguar. Now, if the pound rate is changing, don't you think Tata Motors balance sheet gets affected? Tata Motors company's valuation should get affected. So when you're looking at market risk, if a currency rate changes, if an interest rate changes, if any of the market factors are changing, how will it impact me, my pricing, my models and all? That is market risk. I'm not going to be discussing in this part in detail, because that's a part of your part 2 curriculum. Right. There's another video on the website where you can see the part 2 curriculum in detail that has been covered in an hour and a half, just the way we are going to cover part 1 today. So you'll see that in the next level. The credit risk part relates to, say for example, if I have loaned out money to someone, if he defaults, if he does not pay me the money, that is the credit risk part. That the person I'm giving a loan to, the person I'm fetching money to, he is not gonna give me the money back. Say for example, I'll discuss something over here. Say for example, I have a bet with him. Me and him, we enter into a bet. I'm betting that India is going to win a cricket match and he's supporting Australia, suppose. If India wins a match, I get a 100 rupee note from him. And if India loses the match and if Australia wins, I need to pay him 100 rupees. So we have been doing a betting on that 100 rupee, on that India winning the match or losing the match. Now say for example, let me convert this bet into a little something better. We both are betting. I'm betting with him that dollar rates, the rupee dollar rates are going to increase from 65, are going to change from 66 to 67. He is saying no, it's going to go from 66 to 65. We enter into a bet. I have decided that okay, whatever be the market price, I think it's gonna go to 67, right? Let me contract that I will buy $1 lakh from you at 66 rupees per dollar. So basically you give me $1 lakh, I'll give you 66 lakh rupees. We will do that after a year, after a month. I have contracted with him that after a month I'll give you 66 lakh rupees, you give me $1 lakh. If the rate in the market is 67 rupees, don't you think I've made a benefit, I've made a profit, because I can buy $1 lakh from him at 66 lakh rupees and I can sell it in the market at 67 lakh rupees. And if the rates fall to 65 rupees, he can buy it from the market at 65 lakh rupees and sell it to me for 66 lakh rupees because we have contracted to do so. He can buy the dollar from the market at 65 and sell it to me at 66. So he benefits if the dollar rate falls, if the dollar rate increases 65 rupees, 66 to 65, and I benefit if the exchange rate changes from 66 to 67. Don't you see it is like a bet which I have converted into a contract? Those kind of financial contracts we cover over here. And don't you see I've managed the risk that if my dollar rates are going from 66 rupees per dollar to a 67 rupees per dollar, don't you think I'm managing that risk area? So those kind of contracts, those derivative transactions and all, we are going to be studying here. And when I enter into a contract with him, there is a risk that I will run away with his money if the rate goes from 66 to 65, and he will run away with my money if the rate goes from 66 to 67. That risk that he will run away with my money is credit risk. That is what we discuss in credit risk. Of course, it's not going to be that simple. It's going to be quite complicated. It's going to be quite detailed. Operational risk is now any kind of risk that is not covered in your market, credit and investment is generally a part of operational risk. A fraud that is happening, a theft that is happening, process failures that are happening. So a lot of different risks are there that is going to be in the operational issues, that is your operational risk. Relatively, some people find this content to be a little boring. It gets a little irritating at times to study a part of it because it's going to be a little theoretical in portions. But the most important section of the operational risk is going to be with respect to Basel norms. So I told you that the banks will have regulations, which is like an international regulation all across the globe, and RBI can tell all the banks in India to follow those regulations. They are Basel norms. It was Basel 1 earlier, Basel 2 was there was a little bit of Basel 2.5 also, and now we've got the Basel 3, which is mandatorily going to be implemented by March 2019. Right. In fact, SBI, I read an article, I'm not very sure, I think I remember the figures pretty accurately. 60% or 70% of the people in working in SBI are going to be retiring by 2020. And there's going to be, because, so when you're looking at that, and then the implementation, about 1,76,000 crore is the requirement to infuse in SBI to follow the Basel III norms. So basically there's a lot that is happening in the financial sector with the recession, with the Lehman Brothers collapsing, Greece is collapsing over here, there, then the exchange rate, the demonetization, the whole of Eurozone crisis. We'll be discussing a lot of these things in class also. You need to understand what was Eurozone, what was the Greece crisis, why did that happen, why did Lehman Brothers default. That's a part of your curriculum anyways. You'll do a lot of Lehman Brothers related work and 2007 crisis over here. So basically, anyways, coming back to the content, operational risk was there. Investment risk is when I'm making investments, what is the risk? So that part we'll study over here, very much related to the portfolio risk and all that. That if you have a portfolio, what risk does it have? That we'll cover in the investment risk area. The last one is your current issues, wherein you are going to be the syllabus. The syllabus for current issues has been revised totally. The whole syllabus has been changed for current issues from the past batch, from your, I think from May 2016. So they've changed it. Earlier you had the older issues that was there in the financial market. Now this section is going to totally focus on the 2007 to 2013. The 2007 crisis, why did it happen, what all took place, how did things happen in the US, what are the measures that the government took or the treasury took over there. So all those things with respect to the US crisis, with respect to the 2007 global crisis rather, not the US crisis, the global crisis we will be covering in the current issues segment. Are we okay with the syllabus? Do we have a broad area of what we are going to be covering in FRM? Right? Okay, perfect. So this part I'll erase. May, November, 3rd Saturday, 100 MCQ. Alright. Now let's do our content. Let's do our syllabus for this term in detail. See, I'll give you the exact order of study and the whole list of chapters and all. So we've got 4 books. We've got about 70, 77, 78 topic reviews or chapters that you call it. Every chapter, now it's not like the Indian examination. These exams take place globally. You can give part 1 in India, you can give another part 2 in a London or a US or something. Everybody globally has got the exam almost on the same day and during the same hours. Right? All of you would be having, I think you have all the same papers and it's jumbled up questions when you're sitting in the exam hall. Anyways, I'll discuss that part. So the content is very global. It's not Indian, so you'll not see only a Ram and a Shyam in the examples, the names, and you'll not find only rupee currency. You'll have all the currencies in your examples. You'll have all sorts of names, not just US, you'll have Japanese names and Chinese names and everything. So it's going to be a very global exam. The order of study and all will be provided to you. Let's discuss what's the content. When I look at the foundations of risk management area, I would have broadly, there are a few theory chapters. with respect to, let's say, what is the role of a CRO. Now you have a CEO and a CFO in the company. The CEO is the executive officer, finance officer, operating officer, COO. For an investment company, you'll have a chief investment officer. For an IT company, you'll have a chief technology officer. For any financial banking related company, should have a chief risk officer who's going to be looking at the risk management area. So what is the role of a CRO? What does a CRO do? When you're looking at risk management, we should not have risk management for only one department. We should look at the risk management from the whole company's perspective. Now, say for example, suppose we are talking about an ICICI bank. Now, ICICI Bank, one department has, suppose, given a loan to a US company. There's another department which has invested in a, let's say it's got a client who is selling something in the US company. Suppose what I'm trying to say is, one ICICI bank's one department has got a dollar payable to someone, another department has got a dollar receivable from somewhere. Perfect, it's possible. One department needs to pay dollars, another department needs to receive dollars. Do you think it makes sense to hedge the risk separately? As in, should I manage the risk? Should I get into contracts for two of them separately? If I look at it from an organization-wide perspective, don't you think they're cancelling out each other by themselves? I don't need to manage the risk for these two separately, right? They're managing the risk by themselves. I don't need to manage it separately. So what I'm trying to communicate is that we do not need to, कई बार ना हम लोग को risk अलग-अलग नहीं देखना पड़ता. वो मिला करके जो होगा, that is gonna give you in totality. You should look at the whole firm-wide picture, see what kind of risk is gonna be there. You're getting the idea? So we need to understand that. कि कितना risk है, कितना risk नहीं है, that is going to be depending on a firm-wide basis. So what is the enterprise-wide risk management? ERM. So those kind of theory sections we'll be looking at. Enterprise risk management, etc. There's going to be data related work. So say for example, what kind of data should be there? How should you store data? What kind of measures you should take for data quality management? Now what do you understand by data quality management? Now suppose I am building a lot of risk models for a banking sector. If I take the wrong inputs inside the model, don't you think I'll get the wrong output? And based on the wrong output, if I make a wrong decision, it's going to be a very bad situation for the bank or the financial sector, whatever entity I'm doing this work for. Right? So the point is that we need to look at the data quality, not data quality as in, maintaining paperwork and all. We're not discussing paperwork over here. If you input wrong inputs, if you provide wrong inputs into a valuation model, if I put the wrong inputs from the question in a sum, even if I do the solution properly, I'll not get the right answer if you put the wrong data in the question. Similarly, when you're working with the banking area, when you're working with these financial data, if the data is inaccurate and incorrect, how do you expect to get a correct answer? So that part we'll be looking at in the data quality part in the data section. Boliye, are we good till here? The next part, there are a couple of chapters. One is your financial disasters. One is your GAAP code of conduct. There will be another chapter with respect to risk management in banks. There's going to be a section on portfolio, 3 chapters, and I think I'm missing out on something. Credit crisis. This is how the 2007 crisis started off. This is a little bit about risk management in the banking area. GAAP code of conduct tells you how a risk manager should be behaving. Now say for example, suppose the gentleman comes in to my consulting firm and I want to do risk management. I'm supposed to be doing risk management for his firm. He will be sharing a lot of privileged and private information with him about his company, about his finances. As being a GAAP member, as being an FRM, having the designation FRM, don't you think I should behave ethically? And whatever information he has shared with me, I'm not supposed to be sharing with someone else. So those the code of conduct is going to tell you what is expected from you as a professional. As a professional, it's a very simple 2, 3, 4 page chapter that's going to be very simple. That's your GAAP code of conduct. Financial disaster will have about around 10 examples wherein this went wrong. There was this trader. Now this trader made a mistake and he made a lot of losses. Then what he did was, in order to cover up his losses, he started manipulating accounts and all. And eventually that was discovered and the bank had huge losses and the bank suffered a lot. So how do you manage that? What do we learn from that disaster? The bank failed, and there's this movie on this trader, Nick Leeson. The movie's name is Rogue Trader. So if you guys, you might not be finding that movie that great. Once we do financial disasters, make sure you watch that movie. There's another chapter over here. Once I do MBS, there's a chapter MBS. Once I do that, make sure you watch the movie The Big Short. Once I do Credit Crisis 2007, make sure you watch the movie Insider Trading or Margin Call. The Inside Call. I'm getting confused between 2-3 movies names. I'll tell you the movie's name. So watch those movies also after you're done with these topics. Right. So this is basically what's there in the first book. Financial disaster is going to be talking about 10 such incidents that has happened. So what happened in the incident? What was the fault with the incident? How could it have been prevented? What should we do in order to prevent it in the future? So those are the basics we'll do. Right. It's going to be it's the thinnest of the books. Portfolio is what I'm going to talk about. I'll give you a very simple example. Now, suppose I have investment in, let's say, stock A, stock B, stock C, stock D. Together, what is the total return of the portfolio? That is together is going to be a portfolio. I've got certain equity stocks, I've got certain bonds, I've got certain real estate property, I've got investment in gold and commodity and silver and all. In totality, what is the return of the investment? What is the risk of the investment? That is what we'll cover in the portfolio as a whole, as a portfolio. I'll give you a very simple example. Suppose stock A and stock B. Now, when stock A goes up, stock B also goes up. When stock A goes down, stock B also goes down. So, in totality, don't you see, my portfolio will either increase too much or it will fall too much. Second example, I have two stocks, stock A and stock B. If stock A goes up, stock B goes down. If stock B goes up, stock A goes down. So in totality, when I have these two stocks in my portfolio, don't you see my portfolio gets balanced by one falling, one rising, and I have a little average kind of a return. Don't you see the risk is going to be lower in the second portfolio? Because in the first portfolio, either it's very good, it's very bad. In the second one, it's kind of balanced, so I'll have lower risk. Now, how do you understand whether one stock will go up and one stock will go down, or whether they'll move in the same direction? For those who understand a little bit of statistics, covariance or correlation is something that you can use. Right? Covariance or correlation. So we'll study all those things in statistics in the quant section. Bolo. Are we good till here? So that is your first subject. When we are looking at the second subject, that is your quant, you have a portion wherein you study the time value of money, that is annuity. Now I'll give you a very simple example. Suppose time 0 and this is time 4 years. So we are standing at time 0, that is today, time 0 means today, and this is after 4 years. If I deposit 100 rupee, if I give you an option, I'll either give you 100 rupee today or I will give you $100 after 4 years. Which one would you choose? $100 today instead of getting after 4 years. Why would you do that? Because even if I get $100 today, I can invest it in the bank, and let's say if the interest rate is 7%, I will get a 7% interest every year, and it will become this much. We'll do this. This is called future value. We'll do this when we start quant. Because 100 will become 107 in the first year. 107 I will deposit, and I'll get another 7% on that 107, and that'll become 107 into 1.07. That will become again into 1.07, and that will again into 1.07, and I'll get this. Following? So this annuity, because when you are going to be working in financial products, you cannot compare. Can you compare a 1 meter with a 1 kilometer? No. You either compare a 1 meter with a 0.001 meter, you need to convert the kilometer to meter or meter to kilometer. You cannot compare 100 rupee today with 100 rupee after 4 years. So either you bring this 100 rupees over here and make them comparable, or you bring this 100 rupees over here and you again make them comparable. So in order to make it comparable, we need to look at those calculations. So when you're dealing with the financial products and all, obviously this annuity and the number part will have to be taken care of. Now, say for example, I want to study the growth rate of India, suppose. Now when I'm looking at Indian growth rate or India as a whole, I cannot study all the lakhs of companies over here that's there in India. It's not possible for me to study. What I do is, I study let's say 50 companies or 100 companies in India. I take few banking companies, few FMCG companies, a few automobile companies, and I create a sample of 100 companies for myself. I'll study those 100 companies and I'll try to make projections, I'll try to make predictions about the whole of India. What do? You see two people misbehaving and you say कि आप कौन से school में जाते हैं? अच्छा, so these are the kind of people who turn up from your school. That's how these elderly people talk about. What are you doing? You're looking at the behavior of two children and you're extrapolating. You're saying if these two people are like this, then the whole school is like this. These elderly people have this kind of, you know, the way of whatever, the way of commenting. So anyways, the point is that we are also going to be looking at a sample of companies, and if these companies like an ITC and ICS and all these companies in total are doing like this, Nifty, you look at the index, Nifty, Sensex. So if Sensex or Nifty, that is comprising only of 30 stocks, 52 stocks. So when you're looking at those stocks, if these stocks are performing this way, then the whole of country must be doing somewhat like that. So when you're analyzing data, you need to understand a lot of statistics, mean, median, modes, skewness, kurtosis, standard deviation. And you do not need to have a background of skewness, kurtosis and all. That's absolutely new, and we'll cover it all in quants. So you'll have an annuity portion. You'll have a lot of statistics over here. There is something called hypothesis. So the first section is annuity and statistics. You'll have a little bit of probability. Then you have something called a linear regression. This is almost 30-35% of the chapter. This is another 20-25% of the chapter. Linear regression is, say for example, I want to forecast, let's say, how will SBI perform in the next year, suppose. So I want to form an equation that SBI return is equal to, let's say, something plus something into interest rate. So what I'll do is I'll collect past 1 year data of SBI stock prices or returns. I'll collect last 1 year ka interest rates. This is my column X, this is my column Y. I'll try to plot these points over here in some manner. I'll try to form an equation, and I can get the equation of an SBI return being equal to something plus something into interest rate. Let's say SBI return is equal to 2 plus 5 into interest rate. So whatever is the interest rate, if you can forecast the interest rate, can I not forecast the SBI return? If I'll be able to forecast the interest rate, if interest rate is this, then SBI return is this. If interest rate is that, then SBI return is that. That is linear regression, because we need to do a lot of forecasting, right? We need to understand, we need to project variables, predict variables. So for that portion, we need to do linear regression. And it's possible that we'll get into more details. SBI return is equal to something plus something into interest rate, plus something into GDP, plus something into per capita income. We can have more factors. We can always have more factors involved. So that is going to be multiple regression. So we do that in regression area. There are a few small chapters. That is going to be a little irritating, but don't worry, I'll cover it in a very short way. I'll give you all the markings and everything, because you'll not understand these chapters without it. So we'll have to look into it. There's a little ARMA model is there, your simulation, modeling cycles, characterizing cycles. It's very simple, don't bother. It's not something that is expected of you to know earlier. So it's going to be okay. There are a few small chapters, and there is one chapter which is very important. You don't need to bother. The chapter name will be something else in the book. It is going to be estimating volatilities and correlations. These are the two formulas that you have in the chapter. This chapter is going to be related to this subject, so I'll do it. I'll not do the whole of quants together. I generally do this whole section first. That is how I start, because I need this section in this book and this book. So I try to do these two subjects parallelly. I'll do this whole section together at a stretch. Then in between I'll do a couple of chapters over here, because I don't want to do the whole theory at a stretch, otherwise you'll get irritated and I'll get irritated teaching. You understand me? So kind of there's going to be a little bit of mix over here. The portfolio section requires a little bit of quants. So I need to complete this subject, this portion, so that I can teach these two and I can teach this properly. So I always start with the quants area. So we'll start with this part. This is another section of quants. This generally I do towards the end of the curriculum. So I'll do this much of quants and then I'll stop quants. And this part of quants, because this is going to require a little bit of retention, so I want to do it towards the exam. So the order of study and everything is planned in a very, because see, I'm still studying, and I've been studying, I've been recently done. I mean, my FRM was in 2012, I believe. Not sure. 2012 probably. And Of course, I've been teaching for quite some time now, so I understand, what is required. Now, which subject is going to be related. Now, risk management by banks, and there'll be another chapter in book 4, which you'll do it together. There is a little bit of relation or a link between a few chapters. Like a credit crisis over here has to be done with MBS over here. So exactly that way the order of study will be provided to you. So you'll have to stick to that. You can do a little bit of deviations, but try to stick to that. So we'll firstly, when we start with the syllabus, we'll start with this area, and then we'll go to this part will be done with the syllabus at the end, towards the end of the syllabus, towards the end of the curriculum. This I think I'll try to complete it with, beforehand only, with little bit, because it's a very small subject. The subject is very small, the content is very less compared to the other books. Then we move on to the third book. I think quants is okay. Even if you do not have maths or statistics, do not worry. Just put in a little extra effort. We'll do everything from scratch. So it's not expected that you know something from beforehand. So don't worry. Right? So we'll start absolutely from scratch. Maths should not be a problem. So that's your next book. Then we move on to the third book. Now it has a major content with respect to derivatives. The forward futures is a good segment over here. You have the options part in this book, and you'll again have the options part in this book also. Then you have the fixed income portion over here. Okay. Anyways, so you have the option segment. So when I'll cover options, I'll cover the options of these two books together. So I'll not be going exactly in the serial order. I hope you guys are okay with it. I'll keep on telling you in between and all. So derivatives, you've got forward futures and options. Just give me a second. Then you have the futures, forward segment, swaps is there, options is there. That's more or less it. And the cup, there's going to be a bond. A couple of theory chapters are there with respect to the rating agencies and all. A couple of simple, interesting theory chapters. When I'm talking about theory chapters, I mean to say non-numerical chapters. I'm not implying that you're going to be having absolutely mugging up nonsense. It's not like that. You'll have to understand and learn. There will be portions where you need to, you'll have a couple of chapters which is boring. You cannot have any subject, be it CFA, FRM, CA, CS, MBA, whatever be it. You cannot have 100% curriculum that you like. So there are a few chapters even I dislike, but it's okay. You'll have to manage with it. Right? You have a couple of theory, but they're interesting ones over here. Theory chapters, bonds, different types of bonds and all that's there. MBS means mortgage-backed securities. MBS refers to mortgage-backed securities. Now when this US crisis happened 2007, a lot to do with it was due to the mortgage-backed securities, this area. So mortgage-backed security I'll not be able to teach you in such a short notice. Okay, let's say there is a bank. Bank has issued a lot of home loans. So for the bank, these home loans will be received in the next 20-30 years in the form of EMI. Now for bank, don't you see this is a very illiquid asset that is going to stay on the bank's balance sheet for the next 20-30 years? Because people are going to pay the home loans, the EMIs over the next 20-30 years. It's going to take a long time for the bank to receive this money. It's very illiquid. And it's a huge amount of money, because just imagine thousands of people buying houses and they're taking loans from this bank. The bank can take a loan and give people these loans. So bank is going to take loan from the people. The people will deposit, fixed deposit, current account, savings account. And the bank will give these money to these home loan people. There are a lot of issues with this. What the bank does is, the bank transfers this home loan to another company. People invest in the bonds of this company, and this company purchases all this money all these loans from the bank. These bonds are known as mortgage-backed securities. Actually, I think it's better we skip it, because to introduce this topic, I need 1 hour. I need just 1 hour to explain just this much. So I think I should not have talked about it. We'll ignore this right now. There is a 15-minute video on asset securitization on my website. I'll tell you exactly. You go to my website, you go to the resources section. There is a section called videos. You can click on videos. You have list. you have a CFA videos, you've got the CA videos, you've got the FRM videos. In the FRM, you've got the part 1 classes, you've got part 2 videos. Right. In the part 1 videos, you'll find today's class uploaded. You'll also find a starting area of the quants part, because for other subjects you need it. So you've got the first few classes of quants. You don't need to see it if you're coming to the live classes. For video classes, you can see those, right? Or in case you miss it out. There is a key concept section wherein a small little concepts are discussed. You'll not need those videos right now. You'll first have to start studying, then you can refer to those videos. So over there is a video called asset securitization. For those who want to, they can actually watch that video. So that explains what MBS is about, what this MBS is about. And this was a very important aspect when you cover the credit crisis of 2007. When you cover the credit crisis of 2007, this chapter, MBS and credit crisis, I'll do it together. It's very relatable, right? So that is your book 3. Derivatives, I cannot explain. The one contract we were discussing now, that I'll contract with him, I'll give him 66 lakh rupees to buy the dollars. That kind of contracts, there's like a lot of complicated contracts, a lot of customization we can do with those kind of contracts. So those financial contracts, I entered into a financial contract with him, right? That I'll give you 66 lakh rupees. You take $1 lakh, you give me $1 lakh. Market may, if the rate is 67 or 65, I'm not bothered. I am going to give him 66 lakh rupees and sir is going to give me $1 lakh. That is decided, right? So these kind of contracts we enter because I'm scared that the dollar prices might go up or down or something. Those kind of contracts are covered in derivatives. Very interesting. Derivatives is one of the most important. You have 3-4 chapters of options in book 3 and 3-4 chapters of options in book 4. You have around 5 to 6 chapters based on only fixed income in book 4. So this section, options, is a very important section. You have around 5 to 6 chapters for forwards and futures in book 3. So this is a major content. Derivative is a very important and the most interesting, one of the most interesting and one of my favorites with respect to the finance area. Right? So that is what we studied. Then you have a little bit of swaps and there is another chapter on foreign exchange. Forex is a very easy chapter. Very simple, very easy chapter. Actually, it is a part of forwards futures only. The contract which I was discussing with him, that 1 month later, I will give you 66 lakh rupees and you give me $1 lakh. That is a forward contract. I have gotten into a contract with him today. I have decided all the terms and conditions with him today. But the execution of the contract is going to happen at a forward time period. 1 month later. And 1 month later's prices I do not know. So all those things we'll cover under the derivative section. Just a second. Yes, that's more or less about in the book 3 section part. Book 4 will also have a very important part, that is your VAR section. You have 3-4 chapters on the VAR. You get a good number of questions from the VAR section. So out of 30 questions, you'll have a decent chunk covered in the options part and you have a very decent chunk covered in VAR. You'll need this little chapter also for VAR. There are about 4 chapters for VAR. So value at risk. Let me give you an example. Suppose let's say I create a distribution. I know you do not understand distribution and all. You do not understand distribution, I understand that. But let's just say this is the whole 100% area. Suppose this is the 5% part. Okay. Now this one is, suppose I calculate this value to be 1 lakh. What I can say is there is a 5% probability that my losses will be more than 1 lakh. There is a 95% probability that my losses will be less than 1 lakh. I don't expect you to understand, just understand in a very ambiguous way. We'll do these things. You'll understand normal distribution in your quants. The idea is value at risk. I can make a statement. There is a 2% chance that my losses will be exceeding this much level. So there is only a 2% chance that my loss can be more than this. How do you manage that risk? How do you curtail that risk? That is what we'll study. Right? Hedging the risk, managing risk, mitigating risk. Right? So that is value at risk. That VAR section is quite an important section in your book 4. And along with that, you have a few theory chapters over here also. It's not exactly theory. There are few different chapters. Few other small chapters over here. So that is broadly your course content. That is broadly your course content. I know the number of chapters I've shown is less, but fixed income has got around 5-6 chapters. So these two subjects are actually 30% weightages each. 30% weightage each. So this is going to give you a very good insight into the whole financial domain, the financial products, the financial instruments, the fixed income products, the derivatives is a very important section. These two sections are going to be talking about that. Are we okay with the syllabus? Everybody, more or less. Okay. Now, okay, so this was your pattern and syllabus. How to practice, revise and all those things. So you will be, we would require you to purchase Schweizer books. I do not provide Schweizer books. I can connect you to the bookseller. Generally, he delivers the books to your place and you can deposit the money in his bank account after you've received the book. So it's very simple. You can order the Schweizer books. You'll get 4 books from Schweizer, book 1, 2, 3, 4 for 4 subjects, and you'll get a very thin practice book. You'll get a very slim practice book wherein there will be 200 questions. 2 papers will be given in the practice book with the solution. So you can order for the Schweizer book. That is what you'll get. You'll get 4 books and you will get 1 practice book. Then you will need a calculator. You need a financial calculator. There are generally 2 calculators which is allowed. One is an HP calculator and another one is a Texas Instrument calculator. Everybody uses the Texas Instrument calculator. So without a doubt, you are supposed to be purchasing a Texas Instrument calculator. I'll just write the name of the calculator over here. There are 2 versions to this calculator. One version is this and the other version is the same calculator but the professional version. The buttons on both the calculators are exactly the same. This calculator is going to be somewhere in the 2500 range and this calculator is going to be somewhere in the 3500 range. Right? The difference is this is a plastic body calculator, this is a metal body calculator, and there are a couple of functions which is extra in the calculator, but genuinely $1000 it's not worth it. So most of my students I see, they are using this calculator and that's absolutely fine. You'll have absolutely no issues. The whole buttons and everything is ditto in both the calculators. It doesn't matter. There could be just 1 or 2 very okay kind of functions which you can easily do it with this calculator also. So there is nothing exceptional about this calculator, but yeah, it looks good. It's a metal body calculator and there's a plastic body calculator. So if you want to spend 1000 extra, it's your call. But otherwise it doesn't matter. For my classes, for your exams, it is not going to matter at all. So you can go for either of these calculators. You can purchase them online or you can again connect with the bookseller. I'll connect you, I'll give you all the numbers and everything and you can purchase it yourself. Calculator and the books I am not providing. Right? So that is about your Schweizer. You'll need the Schweizer books. How do you practice? How do you study? Now there will be a practice book. You'll get only 200 questions with the Schweizer books. There are 4 books plus 1 practice book. I will give you another practice book. I will share a lot of online content. I will share the whole online content with respect to whatever content, whatever practice material, it will all be shared with you. The practice material online which is given, it will also be categorized. This is priority 1, this is priority 2. I'll make all the folders and everything and you'll get the content in a very, because see, you have to understand, you cannot practice everything. It's not possible. You'll not have that much of time. Right? You cannot study the institute material, the whole thing, because you'll not have that much time. Whatever extra is to be provided, that will be given to you by me. Whatever handouts are required, that will be provided by me. Practice material is required, that will be given to you. So anything and everything will be taken care of, but you will have to purchase the calculator by yourself. Sorry. And you'll have to purchase the Schweizer books by yourself. The rest of it is all my headache. It's none of your, that is all taken care of by me. Whatever online material, whatever practice material and everything that I'll be giving it, I'll be categorizing it that first you need to complete this, then this much, then this much, in the order of priority. Like this one to karna hi hai, this so you have to do, you don't have an option. This one, if you have time, please try and do. If you don't, then you can skip it. Because there are a lot of people, there are working professionals who try to complete the course in 20 days, 15 days. So there are people who are working with the job, there are students who have more time, but less experience, so they should be practicing more, they should be putting in more time to study. Right? So the practicing part and all I'll take care of. When you're studying, you're basically supposed to be watching a class, you're supposed to be attending a class. That's maybe, let's say I'm doing quant, so I've covered like this part. So try to be with me, whatever you do the class, and then you go back and study your Schweizer. When you're looking at your Schweizer books, say for example, this book is not got it. I'll show you another book actually. So suppose when you're studying with your Schweizer books, so what you should be doing is, I don't know if it will be very visible or not, but basically what you do is, like suppose I have a lot of, let me just open one of the pages. Okay, so suppose I've got this page. Now in this page there are a couple of examples over here. This formula is there. Make your own formula sheets, keep middle sheets in all the 4 books. Whatever formula comes in, make it in your own handwriting. We will provide the formula sheets, but make it in your own handwriting. You have all the formulas at the back of each book also. Try to shorten the content. Use another green, blue, red, whatever pen you want except for black, and try to mark in the book. Because what happens now, during the exams when you're supposed to be revising for the whole one-day exam, you cannot read the whole page. So at the side, small little notes are written. When I start with you, I'll make it a few times. I'll give you a few examples of it, how to make it. Some areas might be complicated. You'll get the simplified version for that. Try to make those short. Try to shorten the content. Try to put in those short things, short small little notes and small little pieces in your book. Try to put maximum stuff inside the book itself, because it's always easier to study from one place. So try to note down small things and make small notes and shorten, like this whole paragraph. The gist of this paragraph is, let's say interest goes up, this goes down. And the whole 20-line paragraph is explaining you that. But the summary of the paragraph is, if interest rate goes up, let's say for example we'll talk about interest rate goes up, then prices go down, therefore demand goes up, therefore this goes down. So basically you just write it beside the 20 lines paragraph, right? When you're revising, it makes it easier now. So you need to shorten your content. So you watch the class or you attend the class, whether it's live or video. You do the class, and after the class you're supposed to be studying that from Schweitzer. So keep on updating with that. Right? That is how you're supposed to be studying. With respect to practice, you start practicing once your content is done. I don't expect you to start practicing immediately after this. Maybe one chunk is over. Like this is one section. One section is over, you start practicing for that. Behind the chapter, you'll have only 4-5 questions. The questions which is there in the Schweitzer books, the questions in your exam should be of a much better standard than that. So I will give you all the practice material, categorized and ordered and everything. You'll need to work with me. Practice is going to be required to a decent extent. You'll need to have a decent amount of practice. So I'll categorize the questions and everything will be provided. You'll need to practice. That's about your how to practice, how to study and all. Now a lot of people ask me the question how to make a timetable and all that. It's very simple. See, you know the number of chapters you have. I'll give you a list of classes, so you'll know approximately how many hours of classes we'll need to cover up. Now say for example if someone is starting in, let's say, December. So I have a December, January, February, March, and let's say I'll not keep April, or let's say I'll keep half of April. I'll not keep April, so I'm thinking we'll start around 15 December, you'll start studying. So if I have 4 months, that means in 4 months if I need to cover this much content, so how much should I cover on a per week basis? For the live classes, if you're with me, as in, if you just keep on updating yourself, your syllabus will be over a month before. That's always my target, that I need to complete the syllabus 1 month before the exam. Your exam is always on the 3rd Saturday. For May 2017, it will be on the 20th of May. So my target would be 20th April, I should be done with the syllabus. So try to update, just whatever I'm teaching, just do that, and that just update the practice of that much, and you're okay. For the video students, you can also look at, say for example, I'm starting very late. I've gotten a little late and I'm starting and I want to study the whole material in 2 months. 2 months, you've got 60 days. Let's say I'll keep another 15 days for revision or something. I've got approximately 40-45 days. So in the 45 days, I need to cover up, let's say, 120 hours of classes, and along with that, I need to study. So approximately 3 hours of classes, and I need to update that. That's all right. So the order of study will be provided. You can, whatever time frame you have, you keep 15 days for your revision, and the remaining days you divide it and you do the syllabus. That's how you schedule your timetable. Once I've given you the order of study, I'll tell you exactly the order of every chapter. That this is the first chapter, this is the second chapter, I'll give you that. So once the order of study you have, you know the total content to be covered, divided by the number of days you have, and you know how to make your timetable. That's as simple as that. Because everybody will have a different way of creating a timetable, right? So that's how you may manage that. Paper grading and the pass percentage. So pass percentage is somewhere around 40 plus minus 5%. It's generally in the range of 38 to 43% or something for part 1 exams. So pass percentage is decent, but since the fees you are paying for the exam is decent, everybody studies for it. Everybody prepares for the exams. And the standard of the paper is going to be decent. Out of 100 questions, you'll have maybe about 7-8 questions which are easy. Maybe 20 questions with a good standard. 30-40 questions which are very good standard, and there could be 10-15 questions which are quite difficult. Now what we've been understanding from the past papers is that questions are coming very analytical and less numerical in nature. So theoretical questions are quite a bit there. So even in the quant section, I can expect a lot of non-numerical questions. When I say theory questions, I do not expect mugged up, what is the definition, kaun se date pe this war was fought. It's not that kind of theory which you can mug up and write. It's going to be very logical, analytical, understanding based theory questions. So there could be a good number of non-numerical questions. So be prepared for that. It's not always going to be number crunching and calculations and formulas and sums. A good chunk of questions now we see is going to be more theoretically based, more non-numerical, understanding based questions. So you have to understand. If you're mugging up this content, if you think you'll mug up the sub books and all and you'll clear your exam, you're not going to pass. Trust me. You have to understand the content. That is why I'm telling you that 70%, 80% of the formulas we'll have to prove it in the class. Because you're not going to be able to mug up the content. Mugging up will not help. It's an MCQ. What will you mug up? Right? Everybody is preparing. You need to be thoroughly prepared. So do not take it very lightly. There are people, I cracked both the levels together in 15 days time period because I did not have time. So it depends but of how much, like say for example, there's a student of mine, he's working in the derivative section. He's working with derivatives. So he understands forwards, futures and options to a certain extent. But again, when you're looking at theoretical part, when you're looking at the curriculum part, there's going to be a lot more. So practical part is a little different. Theoretical part, of course, is going to be a little different. So you need to do the content well. But yeah, if someone is working in some area, he might have a little advantage, right? So that is that. Paper grading, and that is a pass percentage. When you're talking about grading, how much do I need to pass? Now the institute does not tell you that you're going to be needing these many right questions or these many marks or this to pass. So there is no set criteria that if you mark this many questions, you're going to pass. It's not like, I need a 40 marks plus in every subject to pass. It's not like that. You have 100 questions. You will be given, your grades will be provided on a quartile basis. The idea is that for 4 subjects, you'll get whether you're in the first quartile, that whether you're in the top 25% people in this subject, or you're in the second quartile, that is whether you're in the next 25% people who are giving the exam, or the next 25% or the next 25%. So basically, if there are 200 people who are giving the exam, are you in the top 50, the next 50, the next 50 or the next 50? So you'll get a quartile for all the 4 subjects. In general, you're supposed to be performing decently well in all the questions, and if you've covered like around 70%, that's the thumb rule we generally use, but it depends on the kind of paper you've got in the exam. A very difficult paper, maybe less number of questions you might pass, because relatively, see, if there is a 5% pass percentage, that means you need to be in the top 35% performers. That is what it means. And the second thing, so top 35 performers means what? You can have a quartile 1 or 2 kind of something in all the 4 subjects. The more important thing is you cannot fail in any subject. So if you cannot, like you cannot have quartile 1 and a very bad quartile over here. Even if I have marked 80 questions 100% correct and 20 questions are all wrong, I don't think you will clear. Because you cannot fail a subject, right? You need to do on an average you need to do decently well in all the subjects, and in totality you need to be in the top 35 performers. That is how I understand from the exam. The institute does not tell you how exactly you're passing or something. But with my experience, this is what I understand. Right. The next question is your requirements. I've told you the books and calculator that will be needed. The rest of it, everything, practice, everything is going to be taken care of by me. There is no eligibility as such. You'll need to register. Your registrations will be starting, I think it will start 1st December. So it started 1st December. The first deadline gets over on 31st of January. 31st of January, you need to pay $350. So $300 is your registration amount. $300 is your registration. That's a one-time thing. For the exam, you need to pay $350. So the total will be $650 for part 1 if you register until the 31st of January. If you register by the next month, that is by February end, you'll have to pay the $300, that is the one-time fee, plus $475. And if you stretch it to the next deadline, then that is going to be $650. You can confirm the deadlines and the fees and all from the institute's website. You can go to the GARP website and check the fees and the deadlines. Right, but obviously you're expected to cover it up by the first deadline only. Before the 31st of January, you're expected to pay the fees. Do not stretch your fees to the last 30th or the 31st. Please make the payment way before 15th of January. 20th is also fine, 24th, 25th is also fine. Sometime there is a bank strike, kabhi credit card transaction processing or something. Some issue turns up, so I do not advise you to stretch it to the last day or the 31st. Try to make your payments beforehand. Your payments can be made only using credit card, and debit cards will not work. The payments are going to be made only using credit cards. Alright. That's your registration process. There is no eligibility criteria as such. The dates I've told you, the fees I've told you. Some people want to defer their exam, so that is one question that comes up, that if I register the exam, can I defer? The deferment cost is around $100, so you can pay $100 and register and defer your exam. So I enroll for the May exam. If I want to defer it to November, you'll need to pay $100 before a certain deadline, and you can defer your exam. You can check it on the website of the institute. The next question that I get is, I'm just covering all the questions that I keep getting. Can we manage with a job and all? Yes, I have a good number of, especially the video students and all, a good number of students are managing with the job. And if you want to do something, you'll have to stretch a little, because see, the workload is going to increase in future. With whatever job you're working in, your workload will keep on increasing, your timing issue will keep on stretching, your family issues will keep on adding up to it. So the workload and everything is going to keep on increasing. So that is not a reason to defer the exam. You'll never have an easy time. So if you want to do something extra, you want a promotion, you want a department change, you want a better profile, or whatever it is, you need to keep on studying. Right, so, and I keep on studying. I work 7 days a week, but still I keep on studying because my classes are full from Saturday to Saturday, from Sunday to Sunday. But still I'm still studying, and I plan to continue to do so. So I would always say that yes, it's manageable with a job. You need to find out that extra 2-3 hours of time on a daily basis to study. It depends whether you have a 5 months or you have a 2 months to prepare. Whether you can take a 1 week off or a 2 week off before the exams. How much how much can you stretch yourselves? What is your grasping power? A lot of people again question that, I've not been in touch with studies for the last 4 years, 5 years, 10 years, 15 years. Now how do I get into it? How do I get in the studying mode? Shuru mein problem hoga. You'll obviously face a little issue in the first 5 hours, 10 hours. But once you get in the mode of it, it's okay. There's nothing. You've been studying. I mean, even when you're in the office, you're reading a lot of material. You're reading your mails. You're reading your reports and all. You're working with finances and all. So it's fine. It's not going to be that big an issue. Then the time needed to study. So approximately the institute gives that 200 hour, 300 hour thing. It's a very simple logic for me. I'll give you exactly the list of classes and the duration of classes also, based on the past batches classes. So you'll have a rough idea about, how much time we need to prepare. It's approximately 150 hours or something you'll need for your classes. So maybe 120, 150 hours of your classes are there. And along with that, I think the same amount of self-study would take care of it. If you're updating, see, if suppose I teach you a chapter today and you're just studying that chapter the next day, you'll take 2 hours to do that chapter. And if you do it after 2 weeks, then you'll have to again maybe, attend the class again or something, and then then study, and then you'll take more time to study that same part. If you're making those short notes and all, when you're revising, you'll take less time. So try to understand the few things that I'm saying. It'll actually help you in the long run. It'll be quite useful that way. Right. So that is how much time you need. So you need to cover those 120, 150 hours of classes, and along with that, that's your classes over here also, it'll be live. And along with that, you need to keep on updating whatever you studied with me. For those who have not been in touch with the studies, they might take a little extra time to, get in the groove, and that's going to be just for the first few classes. Once that is done, then you're sorted. Then you're in the mode, then you're in the zone, and then I think it's going to be pretty okay. Those who want to start, okay. You do not need maths, that's fine. If you have a maths, it's added advantage, but if you do not have maths, it's fine, you start from scratch. Then the next question I get, those who want to start early. So there are students who want to start early. Let's say, for example, I want to prepare for November. You can always start your studies from May. You can, if you want to take it very light, your job is very pressurizing, and you want, instead of 6 months, you want to take 7-8 months to study, it's your call. It's absolutely up to you. But generally students study towards the end. Maximum amount of study is done towards in the last 2-3 months. So I would personally suggest that, try to cover your exams as quickly as possible. You should always, because you have a lot more to do in future. So speed it up. Okay, what are the things you'll get? I'll give you a checklist. I'll provide you a checklist of what are the handouts you should be getting for different chapters. Like you'll get one for financial disaster, one for data analysis. You'll get one for quantitative hypothesis section. You'll get one for derivative section. You'll get one for probably, you'll get a lot of soft copy practice. You'll get a hard copy practice book as well. You'll be given a textbook also for your practice book. You'll be given these handouts. So I'll give you exact checklist of, what are the things you should be receiving on the soft copy and the hard copy. So you can make sure that you've received everything. So not too much. You need the Schweitzer books, you need to purchase it yourself. You need your calculator by yourself. I'll be providing whatever extra short notes, handouts, etc. Whatever is needed, I'll give you that. those 2-page, 4-page handouts and all. I'll give you all the practice related material. We'll get the practice book, we'll get the practice soft copy also, and it'll be all sorted, and everything will be defined for you. So that is what you'll get. And okay, so for the video classes, for how to purchase books, then I've told you how to practice. It'll all be written. I'll give you the order of practice and sorting and everything. Purchasing books, you can always connect with me. I'll connect you to the bookseller. He can help you out with that. He'll home deliver the books, and you just need to deposit the money in the bank. And you can always text me. I'll send you the details with respect to the bookseller, and you'll have it all sorted. And the next thing is doubt solving. So the live class student, you can always get back to me for the doubts after or before the class. You'll know my schedule. Like say for example, if I have a CFA 1 class, then FRM 1 class, and then there is no class. So you can ask your doubts after the class. And if say for example, I have a FRM 1 class, then CFA 1 class, so then you need to ask me the doubts before. So you can always schedule that. You can always WhatsApp. You can always coordinate. Class में पूछ सकते हो, class के बाद में कोई issue नहीं है. And for the video students, for those who need the doubt solving ones, we are building a platform and everything. But along with that, you'll have the WhatsApp facility. You can always WhatsApp your doubts. Now try to accumulate your doubts, and then I'll WhatsApp it all together, and schedule a time. So I'll keep on giving a time that you can call between this and this hour, and you can solve all your doubts. At times I even send voice notes on doubts and all. So you send me a WhatsApp on the doubt, and voice note is there. The live class people don't do that, because for you guys I'm there over here, so you might as well solve it face to face. And for the video classes, we do that, but not like you cannot be WhatsApping me all throughout the week. So you'll have a time, you can just WhatsApp me there, and you can all get the doubts sorted over there. And anyways, all your doubts will be taken care of. And then there was another question with respect to job prospect and scope of it, and the work experience. So work experience, I'll come to that first. You need a 2 years work experience for FRM. It's not like the CA articleship or something. So that work experience area, you can work after you've done part 1, after you've done part 2, or between part 1 and part 2. It is not an internship or an articleship that you need to do. A normal job that you're doing, if it is related to anywhere related to this, you will need to submit. You don't need to submit any documents to the institute. All you need to do is you need to give a 60 word or I think 150 word or something. You have a word limit or a character limit. Between that, you need to write about your job. You need to describe what work are you doing, how is it related to risk management, and you need to mail it to the institute. You just need to fill in a little form. Once that is done, your work experience is taken care of. You don't need any work experience certificate from any company. It need not be an investment management company. Say for example, I'm working in an iron and steel company, but my job is with respect to the commodity prices moving up and down, and I'm trying to manage the risk with respect to, I'm an exporting company. So the raw material price is very important, and I'm exporting the raw material, the steel pipes or whatever I'm exporting. So there is a dollar rate, exchange rate risk also, and I'm managing the risk part of that. So that kind of job also, whether it's in the steel sector, whether it's in the energy sector, you can always show that as your work experience. It is as provided it is related to your risk management financial domain, right? Even if you're teaching risk management, that is also a part of your risk management domain work experience. So you have that work experience, it's okay. Another question I get, what will I show in my resume? I will not get the FRM designation. Once you've covered part 1, once you've cleared part 1, you can write in your resume, I've cleared part 1 of FRM. Once you've cleared part 2, even if you do not have the charter, even if you do not have the FRM designation, you can still write that I have cleared part 2 exam. Once your 2 years work experience is completed, then you can write the name FRM in front of your name. Then you can write the degree FRM in front of your name. Because even if your work experience is not completed, you can still write that part 2 of FRM you've cleared in the resume. The employer would know that you've done with the FRM, and obviously you need time to get the work experience. So work experience is not an issue as such. It's not an internship, it is not an articleship. The next question was the job prospect and scope of FRM. A lot of people have a question that FRM without CFA is not useful, FRM alone is not useful, and all those things. So the application of FRM is going to be in the financial domain, in the financial sector. In the banking sector, it's going to be very important. I've discussed the Basel norms and all, and in the energy sector. Wherever there, and also, say for example, when you're looking at an Infosys or a TCS treasury department who's trying to manage, let's say, the forex risk. So there's a lot of derivatives and hedging and all which might be required, possible for energy companies, oil companies, for banking companies, for whoever there's a little risk management area is important. For those people, FRM is going to come in useful. Now, I would be very hypocritical on my part. It would be very hypocritical on my part to say that, don't just do an FRM, because I myself have completed all of these. So I am in no position to tell you that khali FRM kar lo. So I'll not comment on that. But it is not, it's not true that FRM does not have a value by itself. I've told you the whole syllabus, and I've told you where what requirements are there. When you're looking at risk management, I gave you the few examples when we started off with the class. How would you need to manage those risks and all? So it's about finding the right place, the right opportunity, the right job at the right time. I'll give you another example. Um, Sorry. I was telling you something else. So when you're looking at an FRM or a CFA, they do not provide campus placement. Like when you're graduating out of college, companies come to your college to take you for jobs. When you're looking at a CA also, CA provides campus placement. There are companies who come to the CA campus, they take candidates out from there. When you go to a B school, a business school, you'll have in the second year, you'll have companies coming to you and they'll be taking you, offering you jobs on the campus. But even for the CA designation, hardly 5 to 10% people get jobs on campus. 90% people apply by themselves and find jobs. Similarly, you are going to be applying for jobs in places and you're going to be finding jobs. You'll be connecting with people on LinkedIn, on HR websites. You'll be forwarding it through your friends who are working in the banks, the investment banks and global banks and all those. And that's how you'll be looking for a job. So I would not try to misguide you, or try to build a very rosy picture that just complete an FRM and 20,000 people will be coming to you, mere paas aa jao, mere paas aa jao. That's not going to happen. That does not happen with the CA. Neither does it happen with MBAs. Now we don't even see the IIMs being able to place everybody. Even the IIM Calcutta was not able to place everybody. Right? So you cannot expect that people are going to be with folded hands, they're going to take you for a job. You'll be applying like everybody else does, and if the market is good, if the financial market is good, if there is a requirement, if there is a post that is required, you'll get the job. Obviously, it's going to be a very, very important added advantage if you're looking at companies, if you're looking at any banking area, if you're looking at any financial area. So there, the scope and application of this degree is going to be to quite an extent energy, financial, banking sector, and there you'll have a lot of scope. As I told you, Basel norms are going to be implemented. Risk management departments, even in the big fours, there is a risk management department, there is a risk advisory department in the Ernst & Young, PwC, Deloitte or KPMG. The big fours are the consulting companies, because a lot of risk management needs to be taken care of. I'm investing in a project, what are the risks? How do you quantify those risks? How do you analyze those risks? How do you mitigate those risks? So a lot of these things are going to be behind that, so you will need to look into those. So those areas, FRM is going to have a lot of application. So that is about your job prospects. I would not want to build a rosy picture, but it is also incorrect to say that FRM does not have a value on its own. You need to find the right opportunity for the right kind of a job. Are we okay with this bit? I think the next questions were, okay, there was another part wherein people questioned me, ki CA, CFA, FRM, what is the common area, what is the common part? Now with respect to CA and FRM, I would hardly find anything common, except for the fact that a little bit of derivatives is covered in the finance paper of the CA final. Finance paper, CA final would cover an introduction over here, but the way CA goes about it, because even in my CA classes, CA final, finance paper, I just take one finance paper for the CA final. I make sure that people are not mugging up and they need to understand the content. Even the the November 2016 paper was little different. The institute is now, the CA institute is now not giving you paper where you can just mug up and write and clear the exams. You need to have a very thorough understanding. And I cannot mug up and I cannot allow my students to mug up. Because CFA, FRM and all these kind of MCQ based papers, it's not possible for you to mug up the exams, mug up the questions and answer. So your understanding needs to be thorough. So this portion, little portion of this one will be a little common, and a little bit of fixed income will be common with CA final. But otherwise it's totally new. The second level is not common with either CFA or FRM or anything at all. When you look at CFA, you combine CFA level 1, 2 and 3 together, then you will have this portion will be common, this portion, MBS portion will also be a bit common, this portion will be common, this is new, this portion will be a little common, not all, maybe 70%, so let's say 60% of valuation will be common with CFA level 1, 2, 3 combined, around 60% would be common CFA level 1, 2, 3 combined. Around 40-50% CFA level 1, 2 combined would be common with this, and only 20% would be common with foundations of risk management. But it's not CFA level 1 overlapping with FRM1. I'm talking about L1, L2, L3 of all the 3 CFA levels combined together. And FRM part 2 has got nothing common with CFA level 1, 2, 3 combined. There is nothing common with FRM part 2. But obviously FRM part 1 is building a finance base, so you're bound to find little things common. But there are differences. This portion is totally new. This portion will have a little bit of overlap. Options, you'll have a couple of new things over here. and the level of difficulty would be relatively higher when you're looking at FRM as compared to CFA level 1. Right. So this is when you question me about, the common between the CFA, FRM and thing. And for video class students, I'll just brief you about how to go about it, enrolling it. You'll have all the details given below the video, or you can always text me, mail me, and the videos and the details will be provided. You can fill in the form, you can deposit the money, you can watch the first few classes. The first few classes of quants are going to be uploaded on the website. So you can watch the videos. If you like the classes, you can make the payment, mail the screenshot and whatever the details are given. You can mail it to the office. You'll have the classes home delivered and you can watch the classes. All the details are provided, and if you cannot find them, it's there in a PDF. The whole details are given, and if you can always ask us and we'll mail it to you. And the contact information and all will be provided to you guys. I think this is all sorted. Any questions from your side? Anything that I have skipped out, have missed out on? Any questions so far? Nothing? Are we good till here? Okay, can you prepare FRM 1 with CA final or something? For that question, if you're looking at CA final part level group 2 and an FRM, not possible because your exams might overlap. Because your group 2 with an FRM part 1 is going to overlap. It's possible. So that I would not advise at all. Group 1 with FRM part 1 would depend on how much of group 1 you've already prepared, how much of FRM you can prepare, how much of holidays do you have with your articleship. It will depend on that. Because for FRM, I would suggest at least a week's revision is definitely required. But if you're just giving a group 1 of a CA inter or a CA final, you'll get that 1 week, 10 days. In fact, you'll get 10 days in between. 10 days, 15 days. So if you have time to prepare right now that you can prepare both the group 1 and the FRM part 1, then you can manage it with it. Then you can manage together with it. But if you got a job and then you want to manage both the things, then it's not happening. I cannot comment that then it's not happening, then it's very, very difficult. I doubt it's going to happen then. I think we are sorted, everybody. Sure.